What's up, everybody? Dan again, Stocktrades.ca. Welcome back to the Stocktrades YouTube channel. I'm going to be putting something to bed this week, something that has been asked a lot on the channel over the last months, and it has to do with a couple structured products and managed products with ETFs, and that is covered call ETFs and split corporation stocks. Now, in this video, I'm going to be speaking on covered call ETFs, but however, with both of these products, it is very, very likely that you are simply burning money if you've been investing in them recently. And I'm going to get into exactly why with covered call ETFs right after this. So again, quick before we get started on the video, smash that like button, head down below, subscribe to the channel. But most importantly, because this is pretty much where I got the idea to make this video, head down below and drop a comment. What do you want to see? What do you not want to see? We make videos based on what you, the watcher, wants to see. So with covered call ETFs, it's pretty important that you actually know what a covered call is. Now, for the sake of this video not running on forever, I'm going to just drop a link in the description below that goes over what an options contract is. So I won't actually speak on what an option is, but I will go into depth on what a covered call is because it is a strategy that I use all the time. So essentially what a covered call strategy is you own the underlying shares for the call option that you're selling. So if you have a call option for a $100 stock, you're going to have something that they call a strike price in that options contract. So with a call option, the strike price gives somebody the right, but not the obligation to buy that stock at a particular price. So say I want to buy a call option on a stock with a $100 strike price and it expires in 3 weeks. What this options contract does is it gives me the right, but not the obligation to buy 100 shares of that stock at $100. So the thing about a call option is if the stock price is below $100, I'm obviously not going to exercise that call option. Why would I do this? Say the stock is trading at $95, I could just buy it for $95. So that option, if it got to its expiration date, would simply expire worthless. But say the stock went up to $110. I would end up exercising this options contract and buying 100 shares for $100 per share. Essentially, this is speculating on price movements of a particular stock. So this is buying a call option. But what if I want to sell a call option and essentially a covered call? What if I want to sell a covered call? I would currently own those 100 shares of that stock, and I would instead sell that call option and gain a premium from selling it to somebody else. When you buy a call option, you will pay a premium, and when you sell a call option, you will get a premium. So say I sell a $100 option, same strike price, and in 3 weeks it expires and they give me $140 for selling that option. That is the premium that I received, and now I'm hoping that my options contract expires worthless. I'm hoping that that stock price stays below $100. I hope that made some sense. It's not complex, but it's pretty hard to explain in a short form video. But essentially deploying a covered call strategy, you're hoping that the stocks you own remain below the strike price of the options contracts you have sold. So now that we know pretty much that when you're selling covered calls, you're hoping to keep stock prices depressed below the strike price that you sold the options contract on, I can now get into a pretty easy explanation as to why covered call ETFs have significantly underperformed their non-covered call variants over the last decade. And don't worry, I'm going to show you clear-cut examples from a whole bunch of covered call options. With a covered call strategy, you're essentially looking to keep prices low. And what have we been in the last 10 years? We have been in besides the March crash of 2020, and epic bull run. A covered call ETF I'll speak on soon, ZWB, that is the Canadian Bank Covered Call ETF. They own Canada's 6 largest banks, and to generate extra income for you, they sell covered call options. But what typically happens on covered calls in a bull market is stock prices rise, and these ETFs are essentially having to sell their stocks for less than they're currently worth. For example, if this covered call banking ETF takes out a call option on, say, $70 on TD Bank, if TD Bank trades at $75 at the time of expiration of the options contract, they're having to sell a $75 stock for $70. So covered calls and covered call ETFs do not work well in a bull run. This is a fact, and I'm going to show you some quick examples right now. So the first covered call ETF we're going to go over is ZWB.TO. This is the BMO Covered Call Canadian Banks ETF. And this ETF is really attractive to Canadian investors because it pays a monthly distribution that is nearly 6%. Whereas ZEB, which is the BMO Equal Bank Weight ETF, what I would consider the non-covered call version, pays a monthly distribution of around 4.1%. So you're getting nearly 50% the distribution, and they seemingly hold the same thing. I mean, the number one holding in this covered call ETF is actually ZEB, the non-covered call variant. But what this ETF aims to do is hold Canada's 6 biggest banks, and they will sell call options to essentially collect premiums that are then paid out to you in the form of a higher distribution. But if we look to overall returns here, we will see that over the last 5 years, the covered call variant ZWB has underperformed by quite a significant margin. I mean, we can look no further to the essential growth of $10,000 over the last 5 years. If you had invested in ZEB, the non-covered call variant, you would be sitting on $17,520. Whereas if you invested in ZWB, the one that sells covered calls, despite the higher distribution, you would have overall returns of $15,960. Now, this chart here is overall returns. This does include dividends. So even though ZWB is paying a higher distribution, it has underperformed over the last 5 years. And in fact, if we extend it out to a 10-year period, the non-covered call variant has still underperformed quite significantly. If we look to total returns over the last 10 years, if you had invested $10,000 in each 10 years ago, right now with ZEB, the non-covered call banking ETF, you would have $23,890. Whereas if you invested in ZWB, the covered call version, you would be sitting on returns of $20,840. So despite paying a 50% higher distribution, ZWB has ultimately left you with less money in your pocket. But this isn't the only covered call ETF that has underperformed, and the next one we're going to look at is the utilities covered call ETF. Now, if you were sitting there thinking, well, that banking ETF, that's only one of them, right? The other ones have to perform better. It actually gets worse. If we go to the BMO Covered Call Utilities ETF, which trades under the ticker ZWU.TO, it essentially contains some of the best utility companies here in Canada, and we compare it to a non-covered call ETF like the BMO Equal Weight Utilities ETF, which is ZUT.TO, we can see that ZWU has a 7.87% distribution. This is a huge yield, and it is very attractive to a lot of investors, whereas ZUT only yields 3.26%. So obviously with ZWU yielding more than double, it has to outperform, right? Well, not really. If we look to the 5-year performance, there is a drastic outperformance of the non-covered call variant ETF. We can see that over the last 5 years, if you had invested $10,000 in both of these, the non-covered call ETF would have you sitting on returns of $21,060, and the covered call ETF would have you sitting on returns of $13,550. Now, sorry for the change of tone, everybody here, but I felt that I needed to add this in after the fact because I knew I would be getting a ton of questions on it. So I am going to explain why I am comparing these two ETFs. Now, when we look at the holdings, I can get it how a lot of people understand that these aren't really the same ETFs, but the fact is this is a BMO covered call utility ETF versus a BMO non-covered call utility ETF. And we can see in the holdings here that the covered call version actually carries the equal weight utilities ETF. And what this covered call variant has attempted to do is target high yielding companies. We can see Pembina Pipe, Enbridge, Fortis, TC Energy, BCE. These are all high yielding companies, and essentially this ETF has sacrificed overall gains to structure it so its distribution is higher. Because if we look to the normal non-covered call utility ETF, we can see that this ETF has targeted for capital growth. I mean, if we see Northland Power, Boralex, Interjex Renewables, TransAlta Renewables, Hydro One, Algonquin Power and Utilities, Brookfield Renewable Partners, these are all renewable energy companies that are not exactly the highest yielding, but they are set up for stronger growth. And this is why you have seen such a drastic outperformance. So if an investor is simply looking for utility ETFs, say a BMO product, then these are ultimately going to be the two ETFs they look at, and that is why I've compared them side by side and essentially showed you the returns of an ETF that is targeting high yield, high distribution versus one that is targeting growth. So the next ETF we're going to talk about is the BMO High Dividend Covered Call ETF. They trade under the ticker ZWC.TO, and we're going to compare it to the non-covered call variant, which is just BMO's Dividend ETF, Canadian Dividend ETF, and they trade under the ticker ZDV.TO. Now, we can see that ZWC has a distribution in the low 8% range, while ZDV yields in the high 4% range. But again, if we look to performance, and of note, the covered call variant hasn't been around that long. It was just introduced in 2017. So this is why you're not seeing much of a historical performance here. But the non-covered call variant continues to outperform. If you invested $10,000 in both of these ETFs when the covered call one was brought to the exchange, you would be sitting at around $11,810 with the non-covered call ETF and $10,980 with the covered call ETF. So this is another ETF where the covered call variation has paid a significantly higher distribution but has ended up underperforming the non-covered call variant. So there's some examples on three of arguably Canada's most popular covered call ETFs. I mean, I'm not going to go into a ton of explanation in terms of examples, but pretty much you can look up most covered call ETFs and they are going to be underperforming their non-covered call variants over this huge bull run we've seen over the last 10 years. You might find a few that have outperformed. I mean, a lot of it depends on the overall management of the ETF. But overall, in my opinion, the only people that these ETFs are well suited for are for essentially people who find the monthly distribution, the higher monthly distribution, absolutely necessary. So think of somebody who's in retirement, who's willing to essentially sacrifice overall returns for a more consistent monthly income so that they can pay their way living in retirement, essentially. People get tunnel vision all the time when it comes to higher yields, and if you're in the accumulation stage of your investing career, as in you're not drawing down or depending on the dividends for living in retirement, it makes absolutely no sense to chase yield over overall returns. And as we've seen from every single one of these ETFs, this has been the case. If you've purchased these, you've sacrificed overall returns for higher distributions, which in my eyes just doesn't make sense unless it is absolutely needed. Now, if the market environment were to change to a bear style market, if the market started falling, it's very likely that these covered call ETFs would outperform. And that is because if we go back to the start of the video, when you sell a covered call option, you're depending on the prices essentially staying flat or falling down below your strike price, or essentially the price you have to sell the stock to the option buyer for. So in a bear market, it's very likely that these ETFs will sell covered call options and collect premiums while holding on to the stocks. So in the end, that could cause them to outperform in a bear market. But generally, a covered call strategy and these covered call ETFs will perform poorly compared to their non-covered call counterparts in a bull market. In a rising stock market, rising stock prices, covered calls are a poor strategy. Overall, I hope you liked the video. I hope this cleared up my opinion, our general opinion over at Stocktrades on covered call ETFs. And I really hope that you can identify whether you absolutely need that monthly distribution, that higher monthly distribution, or if you can sacrifice a little bit of distribution for essentially better overall returns. Obviously, past performance is never a sign of future performance, but if the bull market continues, it is very likely that the covered call ETFs continue to underperform. But again, smash that like button, subscribe to the channel down below, but most importantly, drop a comment. Tell us why you like covered call ETFs versus the non-covered call variants, and also let us know what you want to see next. And we'll continue to keep bringing you great Canadian content. Until next time.